Chapter 5 Admission of a Partner. Number 1 Introduction. Admission of a partner means reconstitution of the partnership. With the admission of a partner, the existing agreement comes to an end and a new agreement among all the partners, including the new partner, comes into existence. The capital contribution by the new partner, his share of profit, goodwill, and other conditions are agreed upon. The new partner, on joining, becomes liable for the liabilities of the firm, and he is also entitled to have a share in the assets and profits of the firm. Section 31 of the Indian Partnership Act 1932 provides that a new partner shall not be admitted in the firm without the consent of all the existing partners, unless it has been agreed otherwise by the partners in the partnership agreement. A new partner may be admitted in a continuing firm because of the following reasons. Number 1. When the continuing firm needs additional capital. Number 2. When the continuing firm requires additional managerial ability. Number 3. When any continuing partner retires or dies. Number 4. When skilled and efficient employees of the firm need to continue in the firm, therefore he is admitted by the firm as a partner. Number 5. For the distribution of risk of the partnership firm. The share of future profits which his incoming partner receives is equal to the sacrifice of profit made by the existing partners of the firm. The new partner compensates the partner or partners who sacrifice their share in profits. The amount he pays against his sacrifice is called goodwill or premium for goodwill. Besides the goodwill or premium for goodwill, he also brings in capital to get right in the assets of the firm and brings goodwill to get right in the profits. Amount of capital remains in the firm while amount of goodwill is distributed among the old partners in their sacrificing ratio. Number 2. Effects of admission of a new partner. Number 1. The old partnership comes to an end and new partnership comes into existence. Number 2. New partner becomes entitled to share future profits of the firm, and therefore the combined share of the old partners' profit gets reduced. Number 3. New partner contributes an agreed amount of capital in cash or in kind of acquires right on the assets of the firm. Number 4. Balances of accumulated profits and losses, reserves and fictitious assets appearing in the books on the date of admission are distributed to the old partners in their old profit sharing ratio. Number 5. Assets are revalued and liabilities are reassessed, and net change is adjusted in the old partners' capital accounts. Number 6. The goodwill of the firm is revalued and new partner contributes his share of goodwill in a cash or kind, and its accounting effect is given. Number 7. Accounting effect is also given for maintaining agreed capital in the new firm among the old partners if decided in the new partnership agreement. Thus, at the time of admission of a new partner, following adjustments are required to be made. Number 1. Calculation of new profit and loss sharing ratio and old partners sacrificing ratio. Number 2. Accounting effects relating to goodwill. Number 3. Accounting effect of profits and losses arising from revaluation of assets and reassessment of liabilities. Number 4. Accounting effect of accumulated profits, losses and reserves. Number 5. Adjustment of change in capital. Number 3. Change in profit sharing ratio. The new partner acquires some share out of the future profit of the firm which is sacrificed by the old partners. Consequently, new profit sharing ratio of all the partners and sacrificing ratio of old partners come into existence after the admission of a new partner. Thus, following two ratios are required to be calculated at the time of admission of a new partner. A. Calculation of new profit-loss sharing ratio. B. Calculation of sacrificing ratio. Calculation of new profit-loss sharing ratio and sacrificing ratio. New profit sharing ratio means ratio in which all partners including the new partner decide to share future profit or loss of the firm. New profit-loss sharing ratio can be calculated as per the following circumstances. Number 1. When sacrificing share or sacrificing ratio of old partners is not given, that is, in other words, when old ratio of old partners and profit share to be given to the old partner is given. When old profit loss sharing ratio of old partners and profit share of new partner is given, it is assumed that the remaining profit after giving share in profit to new partner will be distributed among old partners in their old profit loss sharing ratio. Illustration 1. A and B are the partners in a firm sharing profit and loss in the ratio of 3:2. C is admitted for 1/4 share in the profit. Calculate the new profit sharing ratio. Answer. Old sharing ratio of A and B is equals to 3:2. Let the total share of profit is equals to 1. C's share is equals to 1/4 after giving 1/4 share to C. Remaining share of A and B is equals to total profit minus share of new partner is equals to 1 minus 1/4 is equals to 4 minus 1/4 is equals to 3/4. Remaining share for A and B is 3/4, which is to be distributed in their old sharing ratio 3:2. New share of old partners is equals to remaining share of profit into share in old ratio. A's new share is equals to 3/4 into 3/5 is equals to 9/20. B's new share is equals to 3/4 into 2/5 is equals to 6/20. C's new share is equals to 1/4, making denominator equal 1/4 into 5/5 is equals to 5/20. So new profit sharing ratio of A, B and C is equals to 9:6:5. Explanation. Here it is assumed that the old partners will maintain their relative old ratio even after the admission of a new partner. It means profit share to be given to the new partners will be sacrificed by the old partners in their old ratio only. Therefore, relative old ratio is equals to sacrificing ratio is equals to new ratio. Sacrificing ratio of old partners can be calculated in illustration 1 as under. A, B, C. Old ratio 3:2:0. Old share 3/5 is to 2/5 is to 0. New ratio 9:6:5. New share 9/20 is to 6/20 is to 5/20. Sacrifice is equals to old share minus new share. A is equals to 3/5 minus 9/20 is equals to 12 minus 9/20 is equals to 3/20 and B is equals to 2/5 minus 6/20 is equals to 8 minus 6/20 is equals to 2/20. So, sacrificing ratio of A and B is equals to 3:2. Note, when sacrificing share or sacrificing ratio is not given and the old ratio of old partners and new partners share is given, relative old ratio of old partners will be their sacrificing ratio. Number 2. When the old ratio of old partners, share of new partner and the new ratio of old partners are given. Illustration 2. A and B are the partners sharing profit and loss in the ratio of 3:2. They admitted C as a new partner for 1/4 share in profit. Answer. Old ratio is equals to 3:2. Share of the new partner C is equals to 1/4. Let's assume that total share of profit of firm is 1. Remaining share for A and B after giving share to C is equals to total share minus share of C is equals to 1 minus 1/4 is equals to 3/4. New share for old partner is equals to remaining share of profit into share in old ratio. New share of A is equals to 3/4 into 3/5 is equals to 9/20. New share of B is equals to 3/4 into 2/5 is equals to 6/20. New share of C is equals to 1/4, making denominator equal 1/4 into 5/5 is equals to 5/20. So, new profit sharing ratio of A, B and C is equals to 9:6:5. Sacrificing ratio. Name of a partner A. Old share 3/5. New share 9/20. Sacrifice is equals to old share minus new share is equals to 3/5 minus 9/20 is equals to 60 minus 45/100 is equals to 15/100 is equals to 3/20. Result. Sacrifice. Name of a partner: B. Old share 2 by 5, new share 6 by 20. Sacrifice is equals to old share minus new share is equals to 2 by 5 minus 6 by 20 is equals to 40 minus 30 by 100 is equals to 10 by 100 is equals to 2 by 20. Result: sacrifice. So sacrificing ratio of A and B is equals to 3 by 20 is to 2 by 20 is equals to 3 is to 2. Number 3. When a new partner acquires specific share from old partners. When sacrifice made by old partners is given, new share of old partners can be obtained by subtracting sacrificing share from old share. Thus, new share of old partners is equals to old share minus sacrifice. Number 4. When sacrificing ratio of old partners is given. When sacrificing ratio of old partners is given, sacrificing share of old partners is to be ascertained first with the help of the following formula. Sacrifice of old partners is equals to share of old partner into sacrificing ratio of old partner. New share is equals to old share minus sacrifice. Illustration 3. A and B are the partners of a firm sharing profits and loss in the ratio of 5:3. They admit C, a new partner, who acquires 1/4 share in the firm. C obtains his share from A and B in the ratio of 3:1. Find out new profit-loss sharing ratio. Answer. Old profit sharing ratio of A and B is equals to 5:3, means 5 by 8 and 3 by 8. C's share is equals to 1 by 4. C obtains his share from A and B in the ratio of 3:1. Sacrifice of old partners is equals to new partner's share into sacrificing ratio of old partner. A's sacrifice is equals to 1 by 4 into 3 by 4 is equals to 3 by 16. B's sacrifice is equals to 1 by 4 into 1 by 4 is equals to 1 by 16. New share of old partners is equals to old share minus sacrifice. A's new share is equals to 5 by 8 minus 3 by 16 is equals to 10 minus 3 by 16 is equals to 7 by 16. B's new share is equals to 3 by 8 minus 1 by 16 is equals to 6 minus 1 by 16 is equals to 5 by 16. And C's new share is equals to 1 by 4, making denominator equal, is equals to 4 by 16. New profit-loss sharing ratio of A, B and C is equals to 7:5:4. Number 5. When old partners sacrifice particular fraction of their share in favor of new partner. Illustration 4. A and B are partners. They admit C as a new partner. A sacrifices 1/5 of his share and B sacrifices 1/4 of his share in favor of C. Calculate new profit-loss sharing ratio and sacrificing ratio. Answer. Old profit sharing ratio of A and B is equals to 1:1 means 1 by 2 is to 1 by 2. A sacrifices 1/5 of his share to C. A's sacrifice is equals to A's old share into share of his sacrifice. A's sacrifice is equals to 1 by 2 into 1 by 5 is equals to 1 by 10. B sacrifices 1/4 of his share to C. B's sacrifice is equals to B's old share into share of his sacrifice. B's sacrifice is equals to 1 by 2 into 1 by 4 is equals to 1 by 8. New share is equals to old share minus sacrifice. A's new share is equals to 1 by 2 minus 1 by 10 is equals to 5 minus 1 by 10 is equals to 4 by 10. B's new share is equals to 1 by 2 minus 1 by 8 is equals to 4 minus 1 by 10 is equals to 3 by 8. A and B sacrifice some of their share in favor of C. Therefore, share of A and B will reduce, which is received by C. Sacrifice of A and B will be deducted from their old share and sacrifice of A and B will be received by C. C's new share is equals to 1 by 10 plus 1 by 8 is equals to 4 plus 5 by 40 is equals to 9 by 40. New profit-loss sharing ratio of A, B and C is equals to 4 by 10 is to 3 by 8 is to 9 by 40. Making denominator equal is equals to 16 by 40 is to 15 by 40 is to 9 by 40 is equals to 16 is to 15 is to 9. Now, ascertainment of sacrificing ratio of A and B, A's sacrifice is equals to 1 by 10, B's sacrifice is equals to 1 by 8. Sacrificing ratio of A and B is equals to 1 by 10 is to 1 by 8, making denominator equal 4 by 40 is to 5 by 40 is equals to 4 is to 5. Number 6. When old partners sacrifice some share out of their share in favor of the new partner. Illustration 5. A and B are the partners sharing profit and loss in the ratio of 5:3. They admitted as a new partner. A sacrifices 30% of his share and B sacrifices 20% of his share in favor of C. Answer. Sacrificing ratio of A and B, old ratio of A and B is equals to 5:3 is equals to 5 by 8 is to 3 by 8. So, sacrifice of A is equals to 5 by 8 into 30 by 100 is equals to 150 by 800 is equals to 3 by 16. So, sacrifice of B is equals to 3 by 8 into 20 by 100 is equals to 60 by 800 is equals to 3 by 40. New share of old partner is equals to old share minus sacrifice. So, new share of A is equals to 5 by 8 minus 3 by 16 is equals to 10 minus 3 by 16 is equals to 7 by 16 is equals to 35 by 80. So, new share of B is equals to 3 by 8 minus 3 by 40 is equals to 15 minus 3 by 40 is equals to 12 by 40 is equals to 24 by 80. New share of C is equals to sacrifice of A plus sacrifice of B is equals to 15 by 80 plus 6 by 80 is equals to 21 by 80. New profit loss sharing ratio of A, B and C is equals to 35:24:21. Sacrifice ratio. Sacrifice of A is equals to 3 by 16 into 5 by 5 is equals to 15 by 80. And sacrifice of B is equals to 3 by 40 into 2 by 2 is equals to 6 by 80 is equals to 15:6 is equals to 5:2. Number 7. When one partner from old partners retains his old share after the admission of a new partner. Illustration 6. A, B and C are the partners of a firm. Their profit sharing ratio is 1 by 2, 3 by 10 and 1 by 5 respectively. They admit D as a new partner for 1/6 share. C would retain his original share after D's admission. Calculate new profit loss sharing ratio. Answer. Old ratio of A, B and C is equals to 1 by 2 is to 3 by 10 is to 1 by 5 is equals to 5:3:2, making denominator equal. New partner D's share is equals to 1 by 6. After admission of D, share of C is equals to 1/5 will be maintained. Remaining share for A and B is equals to total share minus C's share minus D's share. Remaining share for A and B is equals to 1 minus 1 by 5 minus 1 by 6 or 1 in bracket 1 by 5 plus 1 by 6 is equals to 30 minus 6 minus 5 whole upon 30 is equals to 19 by 30 or A and B will acquire remaining share 19 by 30 in their relative ratio of 5:3. A's new share is equals to 19 by 30 into 5 by 8 is equals to 95 by 240. B's new share is equals to 19 by 30 into 3 by 8 is equals to 57 by 240, making denominator equal. C's new share is equals to 1 by 5 is equals to 48 by 240. D's new share is equals to 1 by 6 is equals to 40 by 240, making denominator equal. New ratio of profit and loss is equals to 95 is to 57 is to 48 is to 40. Number 8. When sacrifice made by some old partners is given and sacrifice made by other old partner is not given. Illustration 7. A and B are partners sharing in the ratio of 3:2. They admitted C for 1/5 of the profits, out of which he takes 1/20th from A and remaining share from B. Calculate new profit and loss sharing ratio. Answer. B's sacrifice is equals to C's share minus A's sacrifice. C's share is 1/5, out of which he acquires 1/20 from A and remaining B's sacrifice is equals to 1/5 minus 1/20 is equals to 4 minus 1/20 is equals to 3/20. New share is equals to old share minus sacrifice. A's new share is equals to 3/5 minus 1/20 is equals to 12 minus 1/20 is equals to 11/20. B's new share is equals to 2/5 into 3/20 is equals to 8 minus 3/20 is equals to 5/20. C's new share is equals to 1/5 is equals to 4/20. New ratio of profit and loss is equals to 11:5:4. Number 4. Accounting treatment of goodwill as per Accounting Standard 26. Goodwill is an intangible asset. When a firm earns higher profit than normal profit, which is earned by its competitors, super profit arises. Goodwill arises due to the super profit earned by the firm. Goodwill arises in the firm because of the efforts made by old partners in past. On the admission of a new partner, old partners sacrifice some of their profit share in favor of the new partner. To compensate the profit share acquired by the new partner, he is required to give his share in goodwill of the firm, which is called as premium for goodwill. Premium for goodwill is distributed among the old partners in the sacrificing ratio. Sometimes on the admission of a new partner. Number 1. If profit sharing ratio of an old partner does not change even after the admission of a new partner, it means that he does not sacrifice and therefore he will not receive any amount for goodwill. Number 2. If new profit share of an old partner is more than the old profit share, he gains some profit share. On the other hand, other old partner sacrifices in favor of new partner as well as old partner. Therefore, the old partner who gains will have to give goodwill by his share of gain, which is calculated by taking new partner's share in goodwill as base. The sacrificing partner's capital account is credited and gaining partner's capital account is debited. Accounting Para 35 of Accounting Standard 26, internally generated goodwill should not be recognized as an asset. This means that internally generated goodwill should not be shown in the books of accounts. As per Para 26 of this accounting standard, internally generated goodwill is not recognized as an asset because it is not an identifiable resource. That is, it is not separable, nor does it arise from contractual or other legal rights. It is controlled by the entity that can be measured reliably at cost. Thus, AS 26 specifies clearly that goodwill should be shown as an asset in the books only when some consideration is paid for goodwill. Internally generated goodwill should not be shown in the books of accounts. At the time of the admission of a partner, goodwill is valued on the basis of internal resources of the firm like profit, capital employed, expected rate of return, etc. Therefore, goodwill cannot be shown as an asset in the balance sheet of the firm. Looking to this fact, old goodwill appearing in the balance sheet of the old firm must be written off among old partners in their old profit sharing ratio because old partnership is dissolved and a new partnership is reconstituted, that is, reconstructed. From the accounting point of view, goodwill is a compensation for the profit sacrificed by old partners in favor of new partner. Therefore, new partner's share in goodwill is received by all partners in their sacrificing ratio. And if any goodwill appears in the balance sheet of the old firm, it must be written off in all profit-loss sharing ratio among the old partners. From the accounting point of view, there may be different situations relating to treatment of goodwill. These are: number 1, when goodwill is paid privately by the new partner. Number 2, when premium for goodwill is brought in cash or kind by the new partner and it is retained in the business. Number 3, when premium of goodwill is brought in cash by the new partner and it is withdrawn by the old partners fully or partly. Number 4, when the new partner does not bring his share in goodwill in cash. Number 5, when the new partner brings his share in goodwill partly in cash. Number 6, when valuation of goodwill is made on the basis of partner's capital, that is hidden goodwill. Number 1, when the goodwill premium is paid privately by the new partner. When the goodwill premium is paid privately by the new partner to the old partners, no entry is recorded in the books of accounts of the firm. Number 2, when premium for goodwill is brought in cash or kind by the new partner and it is retained in the business. The amount of goodwill brought in cash or kind by the new partner is shared by the sacrificing partners, that is, old partners, in their sacrificing ratio. Accounting entries. Number 1, when premium for goodwill brought in cash by the new partner. Cash bank account debit to premium for goodwill account. Number 2, 1, when premium for goodwill brought in by the new partner, that is, personal land, building, motor car, brought in firm as a goodwill. Land and building account debit, motor car account debit, other assets account debit to premium for goodwill account. Note: instead of above two entries, we can pass one combined entry. Cash bank account debit, land building account debit, motor car account debit, other assets account debit to premium for goodwill account. 2. For the distribution of premium for goodwill among the partners in their sacrificing ratio. Premium for goodwill account debit to old partners' capital current account. Or if out of old partners, any partner gains in new profit-loss sharing ratio compared to old profit-loss sharing ratio, that is, if sacrifice of an old partner is negative, he is also required to give goodwill by his share of gain to other sacrificing partners. Under this situation, following journal entry is passed. Premium for goodwill account debit, old partners, that is, gaining partners, capital or current account debit to old partners, sacrificing partners, capital or current account. Note: goodwill appearing in the books, that is balance sheet of old partners, is written off among the old partners in their old profit-loss sharing ratio, for which following journal entry is passed. Old partners capital or current account debit to goodwill account, shown in old balance sheet. Note: when sacrificing share or sacrificing ratio of old partners is not given, that is, old ratio of old partners and new partners profit share are given. Illustration 8. Ahana and Amina are partners sharing profit loss in the ratio of 3:2. They admitted Aman as a new partner for 1/4 share. The goodwill of the firm is valued at rupees 1,20,000. Aman has to bring rupees 50,000 as capital and his share of premium for goodwill in cash. Pass journal entries regarding goodwill. Answer: journal entries. Date, number, particulars, ledger folio, debit amount, credit amount. Number 1. Cash account debit 80,000 to Aman's capital account 50,000 to premium for goodwill account 30,000. Being cash brought by Aman for capital and for premium for goodwill. Number 2. Premium for goodwill account debit 30,000 to Ahna's capital account 18,000 to Amina's capital account 12,000. Being premium for goodwill distributed by old partners in their sacrificing ratio of 3:2. Explanation. Number 1. New profit loss sharing ratio. Suppose total share of profit is equals to 1. Share of Aman is 1/4. Remaining share of Ahna and Amina is equals to 1 minus 1/4 is equals to 4 minus 1 by 4 is equals to 3 by 4. Remaining share of 3 by 4 is distributed between Ahna and Amina in the ratio of 3:2. New share of Ahna is equals to 3 by 4 into 3 by 5 is equals to 9 by 20. New share of Amina is equals to 3 by 4 into 2 by 5 is equals to 6 by 20. New share of Aman is equals to 1 by 4 is equals to 5 by 20. New profit loss sharing ratio is 9:6:5. Number 2. Sacrificing ratio. Sacrifice is equals to old share minus new share. Ahna is equals to 3 by 5 minus 9 by 20 is equals to 12 minus 9 by 20 is equals to 3 by 20. Amina, 2 by 5 minus 6 by 20 is equals to 8 minus 6 by 20 is equals to 2 by 20. Sacrificing ratio is 3:2. Note, when new sharing ratio or sacrificing ratio is not given, sacrificing ratio will be the old profit sharing ratio. Share of goodwill of Aman is equals to rupees 1,20,000 into 1 by 4 is equals to rupees 30,000. Capital of Aman rupees 50,000 and goodwill rupees 30,000. Total cash rupees 80,000. Number 3. Distribution of premium for goodwill in sacrificing ratio. Ahna, rupees 30,000 into 3 by 5 is equals to rupees 18,000. Amina, rupees 30,000 into 2 by 5 is equals to rupees 12,000. When old ratio of old partners, new partners share and profit loss sharing ratio of all partners are given. Illustration 9. P and Q are the partners sharing profit and loss in the equal proportion. They maintain their capital accounts by fixed capital method. They admitted R as a new partner. At the time of R's admission, goodwill rupees 70,000 was appearing in the balance sheet. R brought rupees 40,000 as his capital in cash. Goodwill is valued at rupees 1,60,000. New profit sharing ratio of P, Q and R is decided at 5:2:1. Answer. Number 1. Share of goodwill of R is equals to rupees 1,60,000 into 1 by 8 is equals to rupees 20,000. Number 2. Sacrificing ratio. Old ratio is equals to 1:1 and new ratio is 5:2:1. Sacrifice by partner is equals to old share minus new share. So, sacrifice of P is equals to 1 by 2 minus 5 by 8 is equals to 4 minus 5 by 8 is equals to minus 1 by 8, that is gain. So, sacrifice of Q is equals to 1 by 2 minus 2 by 8 is equals to 4 minus 2 by 8 is equals to 2 by 8. Here is only sacrifice of Q. Only Q will receive share of goodwill of R. Number 3. Share of goodwill of P is equals to rupees 1,60,000 into 1 by 8 is equals to rupees 20,000. Journal entries in the books of partnership firm of P, Q and R. Date, particulars, ledger folio, debit amount, credit amount. Number 1. P's current account debit 35,000, Q's current account debit 35,000 to goodwill account 70,000. Being old goodwill written off between old partners in their old profit loss sharing ratio 1:1. Number 2. Cash account debit 40,000 to R's capital account 40,000. Being R brought capital in cash. Number 3. R's current account debit 20,000, P's current account debit 20,000 to Q's current account 40,000. Being R's share of goodwill and P's share of goodwill credited to Q's current account. Illustration 10. X and Y are the partners in a firm sharing profit and loss in the ratio of 4:3. They admitted Z as a new partner on 1st April 2016. At the time of admission of Z, balance of capital of X and Y are rupees 30,000 and 40,000 respectively. They decide their new profit sharing ratio at 2:4:1. Z brought rupees 50,000 as his capital and share of goodwill in cash. On the date of admission of Z, goodwill of the firm was valued at rupees 84,000. Goodwill appeared in the balance sheet of X and Y at rupees 35,000. Pass necessary journal entries and prepare all three partners' capital accounts. Answer. Journal entries. Date, number, particulars, ledger folio, debit amount, credit amount. Number 1. X capital account debit 20,000, Y's capital account debit 15,000 to goodwill account 35,000. Being old goodwill is written off among all partners A and B in their old ratio. Number 2. Cash bank account debit 62,000 to Z's capital account 50,000 to premium for goodwill account 12,000. Being Z, the new partner, brought his capital and goodwill in cash. Number 3. Premium for goodwill account debit 12,000, Y's capital account debit 12,000 to X capital account 24,000. Being the goodwill premium of Z and share in goodwill of Y's gain debited to their capital accounts and credited X capital account. Capital accounts of partners. On debit side, date particular X, Y, Z. On debit side, 1st April 2016 to goodwill account X rupees 20,000, Y rupees 15,000. 1st April 2016 to X capital account Y 12,000. 1st April 2016 to balance carried down X 34,000, Y 13,000, Z 50,000. Total of debit side X 54,000, Y 40,000, Z 50,000. On credit side, date particular X, Y, Z. On credit side, 1st April 2016, by balance brought down X 30,000, Y 40,000. 1st April 2016, by cash account Z 50,000. 1st April 2016, by premium for goodwill account X 12,000. 1st April 2016, by Y's capital account X 12,000. Total of credit side X 54,000, Y 40,000, Z 50,000. Old and new profit loss sharing ratios are given. Premium for goodwill is distributed in sacrificing ratio by deducting new share from old share. Due to the admission of Z, sacrifice of X is 2/7 while Y gains instead of sacrifice. Therefore, Y's share in goodwill is debited to his capital account. Premium for goodwill and Y's share in goodwill both will be credited to X capital account. Explanation. Number 1. Sacrificing ratio, old profit sharing ratio of X and Y is equals to 4:3. New profit sharing ratio of X, Y and Z is 2:4:1. Sacrifice is equals to old share minus new share. X sacrifice is equals to 4/7 minus 2/7 is equals to 2/7. Y's sacrifice is equals to 3/7 minus 4/7 is equals to minus 1/7. Ratio of gain. Number 2. Distribution of premium for goodwill. Z's share in goodwill is equals to rupees 84,000 into 1/7 is equals to 12,000. Y gains in new profit loss ratio. Therefore, Y will also give goodwill to X by his share of gain. Goodwill payable by Y is equals to 84,000 into 1/7 is equals to 12,000. Number 3. Goodwill receivable by X. X sacrifice is equals to 2/7. Goodwill receivable by X is equals to 2/7 into 84,000 is equals to 24,000. Number 4. Old goodwill will be written off among old partners in their old ratio. X rupees 35,000 into 4/7 is equals to 20,000. Y rupees 35,000 into 3/7 is equals to 15,000. Number 3. When new partner brings his share of goodwill premium in cash and it is withdrawn by old partners. Journal entries. Date, number, particulars, ledger folio, debit amount, credit amount. Number 1. When old goodwill of the firm appears in the balance sheet of the firm, it is written off between old partners' capital account in their old profit sharing ratio. Old partners' capital account debit to goodwill account. Being old goodwill written off between old partners in their old profit sharing ratio. Number 2. When new partner brings his share of goodwill and his capital in cash, cash account debit to new partner's capital account to premium for goodwill account. Being new partner brought cash for his share of goodwill and capital. Number 3. when premium for goodwill is distributed between old partners in their sacrificing ratio. Premium for goodwill account debit to old partners' capital account, being premium for goodwill distributed between old partners in their sacrificing ratio. Number 4. When premium for goodwill fully or partly withdrawn by old partners in cash. Old partners' capital account debit to cash account, being old partners withdraw their share of premium for goodwill fully or partly in cash. Illustration 11. X and Y are the partners sharing profit and loss in the ratio of 2:3. They admitted Z as a new partner for 1/5 share. Goodwill is valued at Rs 20,000. Balance of goodwill appeared at Rs 15,000 in the balance sheet. Z brought Rs 50,000 as his capital and 80% of his share of goodwill in cash. Old partners withdraw 40% amount of goodwill in cash, which is credited to their capital account. After the admission of Z, the profit of the first year of the new firm was Rs 60,000. Past necessary journal entries. Answer. Number 1. Old ratio is given 2:3. So sacrificing ratio is equals to old ratio is 2:3. Number 2. New sharing ratio. Assume that total share of profit of firm is 1. Remaining share after giving share to Z is equals to 1 minus 1/5 is equals to 4/5. New share is equals to remaining share of profit into old share. So new share of X is equals to 4/5 into 2/5 is equals to 8/25. So new share of Y is equals to 4/5 into 3/5 is equals to 12/25. So new share of Z is equals to 1/5. Making denominator equal, 1/5 into 5/5 is equals to 5/25. So new profit loss sharing ratio is 8:12:5. Number 3. 80% goodwill brought in cash by Z is equals to, in bracket, Rs 20,000 into 1/5 bracket over into 80% is equals to Rs 4,000 into 80 divided by 100 is equals to Rs 3,200. Journal entry in the books of partnership firm of X, Y and Z. Date, particular, ledger folio, debit amount, credit amount. Number 1. X capital account debit 6,000, Y's capital account debit 9,000 to goodwill account 15,000. Being old goodwill written off between old partners in the old profit loss sharing ratio 2:3. Number 2. Cash account debit 53,200 to Z's capital account 50,000 to premium for goodwill account 3,200. Being Z brought 80% of his share of goodwill and capital in cash. Number 3. Premium for goodwill account debit 3,200, Z's capital account debit 800 to X capital account 1,600 to Y's capital account 2,400. Being Z's share of goodwill credited to X and Y's capital account in their sacrificing ratio 2:3. Number 4. Profit loss account debit 60,000 to X capital account 19,200 to Y's capital account 28,800 to Z's capital account 12,000. Being profit after admission of Z distributed between all partners in their new profit loss sharing ratio 8:12:5. Number 4. When the new partner is not able to bring his share of premium for goodwill in cash. If a new partner does not bring his share of goodwill in cash, the new partner's capital account is debited by his share of goodwill and the sacrificing partner's capital account are credited in their sacrificing ratio. The following journal entries are recorded. Journal entries. Date, number, particulars, ledger folio, debit amount, credit amount. Number 1. When new partner brings his capital in cash, cash account debit to new partner's capital account. Being new partner brought his capital in cash. Number 2. When new partner's share of goodwill is debited to his capital account and distributed between old partners in their sacrificing ratio. New partner's capital account debit to old partner's capital account. Being new partner's capital account debited by his share of goodwill and old partner's capital accounts are credited in their sacrificing ratio. Note, there is no difference in journal entries for goodwill written off and withdrawn in cash. Illustration 12. A and B are the partners sharing profit and loss in the ratio of 3:2. They admitted C as a new partner for 1/6 share of profit. C brought rupees 1 lakh in cash as capital, but he is not able to bring his share of goodwill. The goodwill of the firm is valued at rupees 3 lakh at the time of admission of a new partner. Pass necessary journal entries. Answer. Journal entries: date, number, particulars, ledger folio, debit amount, credit amount. Number 1. Cash account debit 1 lakh to C's capital account 1 lakh, being C brought cash as his capital. Number 2. C's capital account debit 50,000 to A's capital account 30,000 to B's capital account 20,000, being C's share in goodwill distributed to A and B in their sacrificing ratio. Explanation. Number 1. C's share in goodwill is equals to 1/6 into 3 lakhs is equals to rupees 50,000. Number 2. C's share of goodwill received by A and B in their sacrificing ratio. A. 50,000 into 3/5 is equals to rupees 30,000. B. 50,000 into 2/5 is equals to rupees 20,000. Note: here old ratio is equals to sacrificing ratio is 3:2. Number 5. When only a part of the premium for goodwill is brought by a new partner in cash. When only part of the premium for goodwill is brought by a new partner in cash, the premium for goodwill account is credited for the amount of premium brought in cash by him. Thereafter, his capital account is debited by the amount of goodwill not brought in cash, and premium for goodwill account is debited by the amount of goodwill brought in cash. And total share of new partner in goodwill is credited to old partners' capital accounts in their sacrificing ratio. Journal entries for old goodwill to write off and goodwill withdrawn by old partners will remain the same as the earlier cases. Journal entries for new partners' share in goodwill in this situation are as follows. Journal entries: date, number, particulars, ledger folio, debit amount, credit amount. Number 1. When part of share in goodwill and his capital brought in by new partner in cash. Cash account debit to new partner's capital account to premium for goodwill account. That is, goodwill brought in cash, being new partner brought capital and his share of goodwill in cash. Number 2. Premium for goodwill account debit, that is, goodwill brought in cash, new partner's capital account debit, that is, goodwill not brought in cash, to old partner's capital account, being new partner's goodwill is distributed between old partners in their sacrificing ratio. Note: there is no change in writing off goodwill will among old partners in their old profit loss sharing ratio. Number 6. When goodwill is valued on the basis of net worth or capital of partners, that is, hidden goodwill. When the amount of goodwill is not given at the time of admission of a partner, goodwill of the firm is valued on the basis of net worth of the firm or capital of partners. For example, A and B, whose capitals in the firm are at rupees 50,000 and rupees 30,000 respectively. They admit C as a new partner for 1/5 share of profits, and he brings in rupees 40,000 as his share of capital. The sacrificing ratio of A and B is equal. In this case, the total capital of the firm should be rupees 2 lakh by taking C's capital as base. 1/5 share is equals to rupees 40,000 capital. Then 1 share is equals to how much? Is equals to rupees 40,000 into 5 is equals to rupees 2 lakhs. But the combined capital of all three partners or net worth is rupees 1,20,000. That is rupees 50,000 plus rupees 30,000 plus rupees 40,000. Goodwill of the firm is equals to net worth of firm on the basis of new partner C's capital minus new worth of the firm excluding goodwill is equals to rupees 2 lakhs minus rupees 1 lakhs is equals to rupees 80,000. C's share of goodwill is equals to rupees 80,000 into 1/5 is equals to rupees 16,000. C's share of goodwill rupees 16,000 will be distributed between A and B in equal proportion. Illustration 13. A and B are the partners sharing profit and loss in the ratio of 3:2. Their capital is rupees 1 lakh and rupees 1,50,000 respectively as on 31st March 2016. On that day, the balance sheet of the firm shows general reserve of rupees 30,000. They admitted C as a new partner for 1/4 share in profit on 1st April 2016. C brings Rs 1,20,000 as a capital. Pass journal entries for goodwill. Show necessary calculation. Answer. Journal entries, date, number, particulars, ledger folio, debit amount, credit amount. Number 1. Cash account debit 1,20,000 to C's capital account 1,20,000. Being C brought capital in cash. Number 2. C's capital account debit 20,000 to A's capital account 12,000 to B's capital account 8,000. Being C's share of goodwill distributed between A and B in their sacrificing ratio. Explanation. Number 1. Calculation of goodwill of the firm. Net worth of the firm, including goodwill, on the basis of C's capital, 1/4 is equals to 1,20,000. So 1 is equals to how much? Is equals to Rs 1,20,000 into 4 is equals to Rs 4,80,000. Net worth of the firm, that is excluding, is equals to old partner's capital plus general reserve plus new partner's capital is equals to Rs 1 lakh plus Rs 1,50,000 plus Rs 30,000 plus Rs 1,20,000 is equals to Rs 4 lakh. Goodwill of the firm is equals to net worth of the firm on the basis of C's capital minus net worth of the firm without goodwill. Goodwill of the firm is equals to Rs 4,80,000 minus Rs 4 lakh is equals to Rs 80,000. C's share of goodwill is equals to Rs 80,000 into 1/4 is equals to Rs 20,000. Number 2. Distribution of C's goodwill. C's share of goodwill will be distributed between A and B in their sacrificing ratio 3:2. Old ratio is equals to sacrificing ratio is 3:2. Goodwill receivable by A is equals to Rs 20,000 into 3/5 is equals to Rs 12,000. Goodwill receivable by B is equals to Rs 20,000 into 2/5 is equals to Rs 8,000. Number 5. Revaluation of assets and reassessment of liabilities and its accounting effects. Fixed assets are recorded in the books of the firm at costless depreciation. Book value of assets at the time of the admission of a new partner may be more or less than its market value. Some assets may not have been recorded in the books. Same thing is possible in the case of liabilities. Actual amount payable may be more or less than its book values. New partner is not entitled to receive any share in the profit due to the change in the values of assets and liabilities till the date of his admission. He will also not share such losses. Therefore, assets and liabilities are revalued at the time of the admission of a partner. To record the change in the values of assets and liabilities on account of their revaluation, an account called revaluation account is opened. It is also called as profit and loss adjustment account. Changes in the values of assets and liabilities are recorded in this account. Net profit or net loss of revaluation account is distributed among the old partners in their old profit sharing ratio. Revaluation of assets and liabilities are recorded by two methods. Number 1. When assets and liabilities are to be shown in the books of the new firm at their new values, that is revaluation account. Number 2. When assets and liabilities are to be shown in the books at their old values, that is memorandum revaluation account. Number 1. When assets and liabilities are to be shown in the books at their new values. In this method, all changes in the values of assets and liabilities are recorded in the revaluation account or profit and loss adjustment account. The net gain or loss of the revaluation account or profit and loss adjustment account is distributed among the old partners in their old profit sharing ratio. Revaluation account is a nominal account. It is debited by the decrease in the value of assets and increase in the amount of liabilities. It is credited by the increase in the value of assets or decrease in the amount of liabilities. By closing the revaluation account, if it shows credit balance, it indicates net gain, and if there is debit balance, it indicates net loss. Net profit or net loss of revaluation account is transferred to the capital accounts of the old partners in their old ratio, and the assets and liabilities will appear in the balance sheet of the new firm at their revised values. Journal entries: date, number, particulars, ledger folio, debit amount, credit amount. Number 1. When value of assets increases. Asset account debit to revaluation account. Number 2. When value of assets decreases. Revaluation account debit to assets account. Number 3. When bad debt reserve and discount reserve is provided on debtors. Revaluation account debit to bad debts reserve account to discount reserve on debtors account. Number 4. Accrued income, prepaid expense, unrecorded assets are to be recorded. Accrued income account debit, prepaid expense account debit, assets account debit to revaluation account. Number 5. When liabilities increases. Revaluation account debit to liabilities account. Number 6. When liability decrease. Liabilities account debit to revaluation account. Number 7. When unrecorded liability or unpaid liabilities are to be recorded. Revaluation account debit to liabilities account to unpaid liabilities account. Number 8. When revaluation account is closed. A. If it is profit of revaluation account, it is distributed among all partners in their all profit sharing ratio. Revaluation account debit to all partners capital account. B. If it is loss of revaluation account, it is distributed among all partners in their all profit sharing ratio. All partners capital account debit to revaluation. Number 2. Memorandum revaluation account. The partners may decide that the value of assets and liabilities will continue to appear in the books at the existing values. Yet, no partner may be put into any undue advantage or disadvantage because of change in values. In such case, an increase or decrease in the amount of assets and liabilities is recorded in the memorandum revaluation accounts. This account is divided into two parts. First part is similar to the revaluation account, and in the second part, all entries of first part are reversed. The balance of first part, that is, profit or loss on revaluation, is transferred to the capital accounts of the old partners in their all profit sharing ratio. The balance of the second part is transferred to all partners, including the new partner, in the new profit loss sharing ratio. That is, if there is profit in the first part, it becomes loss or debit balance in the second part, and if it is debit balance or loss in the first part, it becomes credit balance or profit in the second part. The journal entries are passed in the memorandum revaluation account as follows. Transaction number 1. For increase in assets or decrease in liabilities. Journal entries: assets account debit, liabilities account debit to memorandum revaluation account. Transaction number 2. For decrease in assets or increase in liabilities. Journal entries: memorandum revaluation account debit to assets account to liabilities account. Transaction number 3. For transferring the balance of the first part of the memorandum revaluation account to all partners capital account in all profit sharing ratio. That is, if credit side exceed debit side, that is, in case of profit. Journal entries: memorandum revaluation account debit to all partners capital account. All profit loss sharing ratio. Note: accounting entry for loss is debited to partners capital accounts and credited to the memorandum revaluation account. Transaction number 4. For reversing the first entry. Journal entries: memorandum revaluation account debit to assets account to liabilities account. Transaction number 5. For reversing the second entry. Journal entries: assets account debit, liabilities account debit to memorandum revaluation account. Transaction number 6. For transferring the balance, that is, profit or loss of the second part of the memorandum revaluation account to all including new partners capital account in the new profit sharing ratio. There will be debit balance or loss in the second part as against entry number 3, and reverse effect of entry number 3 will be given in new ratio. Journal entries: all partners capital account debit, new profit and loss sharing ratio to memorandum revaluation account. The 2 points are important about the memorandum revaluation account. If first part of the memorandum revaluation shows loss, then the second part will show profit, and if the first part shows profit, then the second part will show loss. The value of assets and liabilities except cash and capital account will continue to appear at old values in the balance sheet of the firm after reconstitution. Number 6. Distribution reserves and accumulated profit losses. A. Accounting treatments. Balances of reserves, accumulated profits or losses, or fictitious assets appearing in the books of the firm before the admission of a new partner are distributed among old partners in their old ratio because they were created out of the profits earned during earlier period before the new partner was admitted. The new partner should not be put to undue advantage or disadvantage due to such balances. The journal entry will be date, number, particulars, ledger folio, debit amount, credit amount. Profit and loss account, profit, debit, general reserve account debit, capital reserve account debit, reserve funds account debit, contingency reserve account debit, workman compensation reserve account debit, investment fluctuation reserve account debit to old partners' capital or current account, being balances of reserves and profit distributed between old partners in their old ratio. Old partners' capital or current account debit to profit and loss, to advertisement campaign expense account, to research and development expense account, to unamortized other revenue expense account, being balance of loss and fictitious assets distributed to old partners in their old ratio. Workman compensation fund is an amount set aside out of the profit to meet a future liability or a possible loss against workman's compensation claim. At the time of the admission of a partner, the surplus amount of the amount payable, that is, amount of reserve in excess of the liability, is distributed among the old partners in their old profit sharing ratio. If the amount of claim accepted is more than the reserve, the additional amount of claim is debited to the revaluation account and no surplus amount out of reserve will be distributed between old partners. Investment fluctuation reserve is an amount set aside out of the profit to adjust the loss due to fall in the value of investments. At the time of the admission of a partner, the surplus out of the investment fluctuation reserve after deducting decrease in the value of investment is distributed among the old partners in their old profit sharing ratio. If the loss due to decrease in the value of investment is more than the balance of reserve, additional amount is debited to the revaluation account. Balances of reserves and revenue expenditure not written off shown in balance sheet in old firm are recorded by two methods at the time of the admission of a new partner. Number 1. When partners decide to distribute the balances of reserves and accumulated profits and losses. These balances must be distributed among old partners in their old profit-loss ratio even if no instruction is given in the question regarding reserves and accumulated profit and loss. Consequently, these balances will not be shown in the balance sheet of the new firm. Number 2. When partners decide to show the balances of reserve and accumulated profit and loss at the same value without any change. If partners decide not to make any change in the balance of reserves, accumulated profit and loss, and fictitious assets, and show these balances in the new balance sheet at their old values. In this situation, if the net amount of such balances is credit, it is debited to the capital accounts of gaining partner, including new partner, by the amount of gain and credited to sacrificing partner's capital accounts by the amount of sacrifice. If net amount of such balances is debit, it is credited to the gaining partner's capital accounts by the amount of gain and debited to sacrificing partner's capital accounts by the amount of their sacrifice. Illustration 14. P and Q are the partners sharing profit and loss in the ratio of 2:1. They decided to admit R as a new partner on 1st April 2016. All three partners' new profit-loss sharing ratio is decided at 3:1:2. The balance sheet of R and Q show the following balances. General reserve Rs 10,000, profit loss account Rs 11,000, workman compensation reserve Rs 14,000, advertisement campaign expenditure Rs 6,000, research and development expenditure Rs 3,000, investment fluctuation reserve Rs 10,000, Investment Rs 15,000. Market value Rs 14,000. The firm accepted claim of Rs 5,000 for workmen's compensation. From the following situation, pass necessary journal entries. Number 1. When the partners decide to distribute all balance of reserves and accumulated profit and loss. Number 2. When partners decide not to distribute all the balance of reserve and profit and loss, but without any change, all reserve balance is to appear in the balance sheet. Answer. Number 1. When partners decide to distribute balances of all reserves and accumulated profit and losses. Journal entries. Date, particulars, ledger folio, debit amount, credit amount. 1st April 2016, General Reserve Account debit 10,000, Profit and Loss Account debit 11,000, to P's Capital Account 14,000, to Q's Capital Account 7,000. Being balances of General Reserve and Profit and Loss of the firm are distributed between all partners in their all profit sharing ratio. 1st April 2016, Workmen's Compensation Reserve Account debit 14,000, to claim for Workmen Compensation Account 5,000, to P's Capital Account 6,000, to Q's Capital Account 3,000. Being after provision for the accepted claim of workmen compensation, surplus amount is distributed between partners P and Q in their old ratio. 1st April 2016, Investment Fluctuation Reserve Account debit 10,000, to Investment Account 1,000, to P's Capital Account 6,000, to Q's Capital Account 3,000. Being a loss due to fall in the value of investment is adjusted against Investment Fluctuation Reserve and remaining surplus is distributed between all partners in all sharing ratio. 1st April 2016, P's Capital Account debit 6,000, Q's Capital Account debit 3,000, to Advertisement Campaign Expense Account 6,000, to Research and Development Expense Account 3,000. Being balances of advertisement campaign expense and research and development expense are written off by debiting all partners' capital accounts in their old ratio. Note: Number 1. Claim for workmen's compensation of Rs 5,000 will appear in new balance sheet on liabilities side. Number 2. Investment of Rs 14,000 will appear in new balance sheet on asset side. Number 3. Balance of reserves, profit, advertisement campaign expenses and research and development expenses will not appear in balance. Number 2. When partners decide balance of reserves, profit and loss is to be appearing in the new balance sheet without any change. Journal entries, date, number, particulars, ledger folio, debit amount, credit amount. 1st April 2016, R's Capital Account debit 10,000, to P's Capital Account 5,000, to Q's Capital Account 5,000. Being balance of reserves and profit and loss are debited to R's capital in his gaining ratio and distributed between P and Q in their sacrificing ratio. Explanation 1. Balance of reserves, profit and losses. General Reserve Rs 10,000. Profit loss account 11,000. Workmen Compensation Reserve 9,000. That is Rs 14,000 minus Rs 5,000 claim. Investment Fluctuation Reserve 9,000. That is Rs 10,000 minus Rs 1,000 loss on investment. Total Rs 39,000. Less advertisement campaign expense 6,000. Research and development expense 3,000. Net amount, that is credit balance, is Rs 30,000. Number 2. Sacrificing ratio. Old profit and loss sharing ratio of P and Q is 2:1. New profit loss sharing ratio of P, Q and R is 3:1:2. Sacrifice is equals to old share minus new share. P's sacrifice is equals to 2/3 minus 3/6 is equals to 1/6. Q's sacrifice is equals to 1/3 minus 1/6 is equals to 1/6. Sacrificing ratio is equals to 1:1. Net balance of reserves, profit and loss Rs 30,000 into 2/6. Gain share of R is equals to Rs 10,000 is debited to R's capital and distributed between P and Q in their sacrificing ratio. Number 3. Different circumstances arising for reserves disclosed in the books of old partnership firm. Reserves are created by a partnership firm against the possible losses in the assets. These assets are revalued at the time of the admission of a partner. Different situations arise at the time of revaluation. Required accounting treatment in such situation increases reliability of accounts. These reserves include investment fluctuation reserve, bad debt reserve, workers' accident compensation reserve, etc. Illustration 15. Isha and Rucha are the partners in a firm sharing profit and loss equally. Balances of their firm as on 31st March 2016 were as under. Balance: investment 50,000, debtors 40,000, investment fluctuation reserve 6,000, bad debt reserve 3,000, workmen compensation reserve 10,000, workmen profit sharing fund 2,000. They admitted Eva as a new partner for 1/5 share in the firm on 1st April 2016. Pass journal entries in following cases. Number 1. If investments are valued as under 1. Rupees 48,000, 2. Rupees 40,000, 3. Rupees 60,000, 4. Rupees 50,000. Number 2. If following amount of workmen compensation claim is accepted: 1. 0, 2. Rupees 6,000, 3. Rupees 12,000. Number 3. If provision for bad debt is to be made as follows. Number 1. New provision for bad debt reserve is not required. Number 3. Provision for bad debt reserve on debtors is to be kept 10%. Number 3. Provision for bad debt reserve on debtors is to be kept 5%. Number 4. After writing off bad debt, Rs 5,000 provision for bad debt reserve is to be kept at 10%. Number 5. All debtors are solvent. Answer. Number 1. 1. If value of investment is Rs 48,000, investment fluctuation reserve account debit 6,000, to investment account 2,000, to Isha's capital account 2,000, to Rucha's capital account 2,000. Being decrease in the value of investment is written off against investment fluctuation reserve, and balance amount of investment fluctuation reserve is distributed among all partners in all profit loss sharing ratio. 2. If value of investment is Rs 40,000, investment fluctuation reserve account debit 6,000, revaluation account debit 4,000, to investment account 10,000. Being investment fluctuation reserve is written off against decrease in investment, and balance amount of decrease is debited to revaluation account. 3. If value of investment is Rs 60,000, A. Investment account debit 10,000, to revaluation account 10,000. Being increase in the value of investment is credited to revaluation account. B. Investment fluctuation reserve account debit 6,000, to Isha's capital account 3,000, to Rucha's capital account 3,000. Being balance of investment fluctuation reserve is distributed between all partners in all profit loss sharing ratio. 4. If value of investment is Rs 50,000, investment fluctuation reserve account debit 6,000, to Isha's capital account 3,000, to Rucha's capital account 3,000. Being remaining balance of investment fluctuation reserve is distributed between all partners in all profit loss sharing ratio. Explanation. Explanation regarding investment fluctuation reserve. Investments, particular: number 1 rupees, number 2 rupees, number 3 rupees, number 4 rupees. New value: number 1 48,000, number 2 40,000, number 3 60,000, number 4 50,000. Less old value: number 1 50,000, number 2 50,000, number 3 50,000, number 4 50,000. Increase or decrease: number 1 2,000, number 2 10,000, number 3 10,000, number 4 nil. Number 1. Investment fluctuation reserve is Rs 6,000. Decrease in the value of investment is Rs 2,000, which is deducted from reserve, and balance of reserve Rs 4,000 is credited to partners' capital accounts in their profit loss sharing ratio. Number 2. Decrease in investment is Rs 10,000. Therefore, Rs 6,000 of reserve will be fully utilized, and balance of decrease Rs 4,000, that is Rs 10,000 minus Rs 6,000, is debited to revaluation account. Number 3. Value of investment is increased by Rs 10,000. Therefore, entire amount of reserve is credited to partners' capital accounts. Number 4. There is no change in the value of investment. Therefore, entire amount of reserve is credited to partners' capital accounts. 2. 1. If the claim of workman compensation is 0, workman compensation reserve account debit 10,000 to Isha's capital account 5,000 to Rucha's capital account 5,000. Being balance of workman compensation reserve is distributed between all partners in all profit-loss sharing ratio. 2. If the claim of workman compensation is Rs 6,000, workman compensation reserve account debit 10,000 to provision for workman compensation claim account 6,000 to Isha's capital account 2,000 to Rucha's capital account 2,000. Being provision made for claim of workman compensation and remaining balance of workman compensation reserve is distributed between all partners in all profit-loss sharing ratio. 3. If the claim of workman compensation is Rs 12,000, workman compensation reserve account debit 10,000, revaluation account debit 2,000 to provision for workman compensation claim account 12,000. Being provision made for claim of workman compensation by fully utilizing workman's compensation reserve and balance amount of provision is debited to revaluation account. Explanation. Explanation regarding workman compensation reserve. Investment, particular. Number 1 rupees, number 2 rupees, number 3 rupees. Amount of accident compensation reserve less liabilities decided. Number 1, 10,000 minus 0. Number 2, 10,000 minus 6,000. Number 3, 10,000 minus 12,000. Increase or decrease. Number 1 rupees 10,000. Number 2 rupees 4,000. Number 3 rupees 2,000. Number 1. The amount of option 1 and 2 is rupees 10,000 and 4,000 respectively, and it is credited to partners' capital accounts in their all profit-loss sharing ratio. Number 2. In option 3, the liability is decided as rupees 12,000. Rupees 10,000 of reserve are only utilized and balance amount of rupees 2,000 is debited to the revaluation account. 3. 1. If new provision for bad debt reserve is not required, bad debt reserve rupees 3,000, that is old balance, will be deducted from debtors of rupees 40,000 in balance sheet. Bad debt reserve is a provision for future possible bad debt, so it cannot be distributed between all partners. 2. If provision for bad debt reserve on debtors is to be kept 10%, revaluation account debit 1,000 to bad debt reserve account 1,000. Being additional bad debt reserve is debited to revaluation account. Note: provision for bad debt at 10%, rupees 4,000 will be deducted from debtors rupees 40,000 and debtors at rupees 36,000 will be shown in the new balance sheet of the firm. Number 3. If provision for bad debt reserve is to be kept 5% on debtors, bad debt reserve account debit 1,000 to revaluation account 1,000. Being surplus of bad debt reserve is credited to revaluation account. Note: provision for bad debt at 5%, that is rupees 2,000, will be deducted from debtors of rupees 40,000 and debtors at rupees 38,000 will be shown in the new balance sheet of the firm. 4. After writing off bad debt rupees 5,000, the provision for doubtful debt is to be made at 10%. A. Bad debt account debit 5,000 to debtors account 5,000, being bad debt written off. B. Revaluation account debit 2,000, bad debt reserve account debit 3,000 to bad debt account 5,000, being bad debt written off against the old balance of bad debts reserve and additional amount of bad debt debited to revaluation account. C. Revaluation account debit 3,500 to bad debt reserve account 3,500, being new provision is made for bad debt reserve on debtors after deducting bad debt. Note: in balance sheet of new firm, rupees 5,000 bad debt will be deducted from debtors of rupees 40,000 and 10% new bad debt reserve will be provided on balance of debtors rupees 35,000 and debtors will be shown at rupees 31,500 after deducting new bad debt reserve. 5. If all debtors are good, bad debt reserve account debit 3,000 to revaluation account 3,000. Being bad debt reserve is credited to revaluation account as it is now not required. Investment, particular. Number 1 rupees, number 2 rupees, number 3 rupees, Number 4, rupees. Number 5, rupees. Bad debt reserve, old. Number 1, 3000. Number 2, 3000. Number 3, 3000. Number 4, 3000. Number 5, 3000. Less bad debt, new. Number 4, 5000. Surplus of old bad debt reserve. Number 1, 3000. Number 2, 3000. Number 3, 3000. Number 4, 2000. Number 5, 3000. Less new bad debt reserve. Number 1, sufficient. Number 2, 4000. Number 3, 2000. Number 4, 3500. Number 5, not required. Therefore, 1000, 1000, 5500, 3000. Number 1, no accounting effect. Number 2, debited to revaluation account. Number 3, credited to revaluation account. Number 4, debited to revaluation account. Number 5, credited to revaluation account. Number 7, change in capital accounts and construction of new balance sheet. Illustration 16. Abha and Bina are partners in a firm sharing profit and loss in the ratio of 2:1. Their balance sheet as on 31st March 2017 was as under. Balance sheet as on 31st March 2017. Liabilities, amount, assets, amount. On liabilities side, capital account, Abha 80,000, Bina 60,000, total 1,40,000. General reserve 18,000. Workman's compensation reserve 4,500. Investment fluctuation reserve 1,500. Creditors 28,000. Bills payable 12,000. Total of liabilities 2,04,000. On asset side, goodwill 18,000. Land and building 72,000. Machinery 40,000. Stock 36,000. Debtors 24,000. Less bad debt reserve 2,000. Total 22,000. Investments 8,000. Cash bank 2,000. Advertisement campaign expense 6,000. Total of assets 2,04,000. They admitted Rushil as a new partner from 1st April 2017 on the following conditions. Number 1. Rushil will bring rupees 1 lakh as his capital and rupees 24,000 as goodwill in cash. Number 2. Value of land and building is to be increased by rupees 17,000. Number 3. Value of machinery is to be decreased up to rupees 32,000. Number 4. Provision for bad debt is to be kept at 10% on debtors. Number 5. Provision for outstanding electricity bill is to be made at rupees 1,100. Number 6. New profit sharing ratio of all three partners is to be kept at 2:1:2. Pass necessary journal entries and prepare revaluation account, partners' capital accounts, cash bank account and balance sheet after admission. Answer. Necessary calculation. Number 1. Old ratio is 2:1. New ratio is 2:1:2. Sacrifice by partner is equals to old share minus new share. Sacrifice of Abha is equals to 2/3 minus 2/5 is equals to 10 minus 6/15 is equals to 4/15. Sacrifice of Bina is equals to 1/3 minus 1/5 is equals to 5 minus 3/15 is equals to 2/15. So sacrificing ratio is equals to 4/15 is to 2/15 is equals to 4:2 is equals to 2:1. Number 2. Distribution of goodwill is distributed to both old partners in 2:1 ratio. Share of goodwill of Abha is equals to rupees 24,000 into 2/3 is equals to rupees 16,000. Share of goodwill of Bina is equals to rupees 24,000 into 1/3 is equals to rupees 8,000. Journal entry in the books of partnership firm of Abha and Bina. Date, particulars, ledger folio, debit amount, credit amount. Number 1. General reserve account debit 18,000 to Abha's capital account 12,000 to Bina's capital account 6,000. Being general reserve distributed between old partners in their old profit loss ratio. Number 2. Workman compensation reserve account debit 4,500 to Abha's capital account 3,000 to Bina's capital account 1,500. Being workman compensation reserve distributed between old partners in their old profit loss ratio. Number 3. investment fluctuation reserve account debit 1500 to Abha's capital account 1000 to Bina's capital account 500. Being investment fluctuation reserve distributed between all partners in their all profit loss ratio. Number 4. Abha's capital account debit 12,000, Bina's capital account debit 6,000 to Goodwill account 18,000. Being all goodwill written off between all partners in their all profit loss sharing ratio. Number 5. Abha's capital account debit 4,000, Bina's capital account debit 2,000 to advertisement campaign expenditure account 6,000. Being advertisement campaign expenditure written off between all partners in their all profit loss sharing ratio. Number 6. Cash account debit 1,24,000 to Rushil's capital account 1 lakh to premium for goodwill account 24,000. Being capital and goodwill brought by Rushil in cash. Number 7. Premium for goodwill account debit 24,000 to Abha's capital account 16,000 to Bina's capital account 8,000. Being premium for goodwill distributed between all partners in their sacrificing ratio. Number 8. Revaluation account debit 9,500 to machinery account 8,000 to bad debts reserve account 400 to outstanding electricity expense account 1,100. Being decrease in machinery, increase in bad debt reserve and outstanding electricity expense debited to revaluation account. Number 9. Land building account debit 17,000 to revaluation account 17,000. Being increase in land and building credited to revaluation account. Number 10. Revaluation account debit 7,500 to Abha's capital account 5,000 to Bina's capital account 2,500. Being profit of revaluation account distributed between all partners in all ratio. Total of debit side 2,30,000. Total of credit side 2,30,000. Revaluation account. On debit side, particulars amount. On credit side, particulars amount. On debit side, to machinery account 8,000, to bad debts reserve account 400, to outstanding electricity expense account 1,100, to capital accounts profit 2:1, Abha 5,000, Bina 2,500, total 7,500. Total of debit side 17,000. On credit side, by land building account 17,000, total of credit side 17,000. Partners capital account. On debit side, particulars Abha rupees, Bina rupees, Rushil rupees. On credit side, particulars Abha rupees, Bina rupees, Rushil rupees. On debit side, to goodwill account old Abha rupees 12,000, Bina rupees 6,000. To advertisement campaign expense account Abha rupees 4,000, Bina rupees 2,000. To balance carried down Abha rupees 1,01,000, Bina rupees 70,500, Rushil rupees 1 lakh. Total of debit side Abha 1,17,000, Bina 78,500, Rushil 1 lakh. On credit side, by balance brought down rupees 80,000, Bina rupees 60,000. By general reserve account Abha rupees 12,000, Bina rupees 6,000. By workmen compensation reserve account Abha rupees 3,000, Bina rupees 1,500. By investment fluctuation reserve account Abha rupees 1,000, Bina rupees 500. By cash account Rushil rupees 1 lakh. By premium for goodwill account Abha rupees 16,000, Bina rupees 8,000. By revaluation account profit Abha rupees 5,000, Bina rupees 2,500. Total of credit side Abha rupees 1,17,000, Bina rupees 78,500, Rushil rupees 1 lakh. Cash bank account. On debit side, particulars amount to balance brought down 2,000 to Rushil's capital account 1 lakh to premium for goodwill account 24,000. Total of debit side 1,26,000. On credit side, by balance carried down 1,26,000. Total of credit side 1,26,000. Balance sheet as on 1st April 2017 after admission of Rushil. On capital liability side, capital Abha 1,01,000, Bina 70,500, Rushil 1 lakh. Total 2,71,500. Creditors 28,000, bills payable 12,000, Outstanding electricity expenses 1100. Total of capital liabilities 3,12,600. Assets receivables, land building 72,000, add increases 17,000, total 89,000, machinery 40,000, less decreases 8,000, total 32,000, stock 36,000, debtors 24,000, less bad debt reserve 2,400, total 21,600, investment 8,000, cash bank 1,26,000, total of assets receivable 3,12,600. Illustration 17. Astha and Ahana are partners in a firm. The balance sheet of the firm as on 31st March 2017 was as under. Balance sheet as on 31st March 2017. Liability side, capital account Astha 76,000, Ahana 48,400. Total 1,24,400. Workman compensation fund 4,800. Investment fluctuation fund 1,600. Provident fund 6,400. Bad debt reserve 8,000. Creditors 12,000. Bills payable 6,000. Total of liabilities 1,63,200. On asset side, goodwill 8,400. Land building 40,000. Machinery 32,000. Investments 20,000. Debtors 25,200. Stock 14,400. Cash 16,000. Advertisement campaign expenditure 3,200. Profit loss account 4,000. Total of assets 1,63,200. They admitted Sonu as a new partner as on 1st April 2017 on the following condition. Number 1. Sonu will bring Rs 80,000 as her capital and Rs 7,200 as her share of goodwill in cash. Number 2. New profit and loss sharing ratio will be 4:3:3. Number 3. Goodwill is to be valued at Rs 40,000. Number 4. The claim of workman compensation is accepted at Rs 3,200. Number 5. Ahana will take over investments at Rs 19,200. Number 6. Accrued interest on investment Rs 2,400 is not recorded. Number 7. Accepted bills payable of Rs 2,000 which was drawn by creditors is not recorded. Number 8. Book value of land building is 20% less than its market value. Number 9. Out of insurance premium paid, Rs 4,800 is for next year. Prepare necessary accounts and balance sheet after admission. Answer. Necessary calculation. Number 1. Old ratio is equals to 1:1. New ratio is equals to 4:3:3. Sacrifice by partner is equals to old share minus new share. Sacrifice of Astha is equals to 1/2 minus 4/10 is equals to 5 minus 4/10 is equals to 1/10. Sacrifice of Ahana is equals to 1/2 minus 3/10 is equals to 5 minus 3/10 is equals to 2/10. So sacrificing ratio is equals to 1/10 is to 2/10 is equals to 1:2. Number 2. Share of goodwill of Sonu. Share of goodwill of Sonu is equals to Rs 40,000 into 3/10 is equals to Rs 12,000. Sonu brought Rs 7,200 in cash and remaining Rs 4,800, that is Rs 12,000 minus Rs 7,200 does not bring cash for goodwill. Journal entries for goodwill will be as under. Number 1. Cash account debit 7,200 to premium for goodwill account 7,200. Number 2. Premium for goodwill account debit 7,200 to Astha's capital account 2,400 to Ahana's capital account 4,800. Number 3. Sonu's capital account debit 4,200 to Astha's capital account 1,600 to Ahana's capital account 3,200. Number 3. Market value of land building. Book value of land building is 20% less than its market value. Suppose market value is Rs 100, less 20% less Rs 20. So book value is Rs 80. If book value is Rs 80, then market value is Rs 100. So if book value is Rs 40,000, then market value is how much? Is equals to Rs 40,000 into Rs 100 divided by Rs 80 is equals to Rs 50,000. Revaluation account. On debit side, particulars amount on credit side, particulars amount on debit side to capital accounts. Profit 1:1. Astha 8,600, Ahna 8,600. Total 17,200. Total of debit side 17,200. On credit side, by outstanding interest on investments account 2,400, by land building account 10,000, by prepaid insurance premium account 4,800. Total of credit side 17,200. Partners capital accounts. On debit side, particulars Astha, Ahna, Sonu. On credit side, particulars Astha, Ahna, Sonu. To Astha's capital account, Goodwill, Sonu 1,600. To Ahna's capital account, Goodwill, Sonu 3,200. To investment account, Ahna 19,200. To Goodwill account, Astha 4,200, Ahna 4,200. To advertisement campaign expense account, Astha 1,600, Ahna 1,600. To profit loss account, Astha 2,000, Ahna 2,000. To balance carried down, Astha 82,000, Ahna 39,200, Sonu 75,200. Total of debit side, Astha Rs 89,800, Ahna Rs 66,200, Sonu Rs 80,000. On credit side, by balance brought down, Astha 76,000, Ahna 48,400. By cash account, Sonu 80,000. By Sonu's capital account, Goodwill, Astha 1,600, Ahna 3,200. By premium for Goodwill account, Astha 2,400, Ahna 4,800. By workman compensation fund account, Astha 800, Ahna 800. By investment fluctuation fund account, Astha 400, Ahna 400. By revaluation account, profit, Astha 8,600, Ahna 8,600. Total of credit side, Astha Rs 89,800, Ahna Rs 66,200, Sonu Rs 80,000. Cash account. On debit side, particulars amount. On credit side, particulars amount. On debit side, to balance brought down 16,000, to Sonu's capital account 80,000, to premium for Goodwill account 7,200. Total of debit side 1,03,200. On credit side, by balance carried down 1,03,200. Total of credit side 1,03,200. Balance sheet as on 1st April 2017 after admission of Sonu. Capital liabilities amount. Assets receivables amount. Capital liabilities. Capital accounts Astha 82,000, Ahna 39,200, Sonu 75,200. Total 1,96,400. Provident fund 6,400. Bad debts reserve 8,000. Creditors Rs 12,000 less Rs 2,000. Bills payable 10,000. Bills payable Rs 6,000 add Rs 2,000. Total 8,000. Provision for workmen's compensation claim 3,200. Total of capital liabilities 2,32,000. Assets receivable, land building 50,000, machinery 32,000, debtors 25,200, stock 14,400, cash 1,03,200, outstanding interest on investments 2,400, prepaid insurance premium 4,800. Total of assets receivables 2,32,000. Illustration 18. Kanha and Kavisha are partners in a firm sharing profit and loss in the ratio of 2:3. Balance sheet of their firm as on 31st March 2016 was as under. Balance sheet. Liabilities amount, assets amount. On liabilities side, capital Kanha 80,000, Kavisha 1 lakh. Total 1,80,000. Contingency reserve 15,000. Workman's compensation fund 40,000. Investment reserve 12,000. Creditors 50,000. Bad debt reserve 3,000. Total of liabilities 3 lakh. On asset side, building 1,10,000. Machinery 50,000. Stock 30,000. Debtors 66,000. Bank 14,000. Investment 30,000. Total of assets 3 lakhs. They admitted Palki as a new partner on 1st April 2016 on following terms. Number 1. Kanha sacrifices half of her share and Kavisha sacrifices 1/4 of her share in favor of Palki. Number 2. Goodwill of the firm is valued Rs 80,000. Number 3. Kanha and Kavisha will withdraw 50% of their share of goodwill. Number 4. Depreciation on machinery is to be provided at 10%. Number 5. Bad debt of Rs 6,000 is to be written off and provision for bad debt reserve is to be kept at 15% on debtors. Number 6. Market value of investment is Rs 15,000. Number 7. Claim for workmen's compensation to be accepted Rs 50,000. Number 8. 10% of creditors are not to be paid. Number 9. Palki will bring Rs 1,20,000 as capital and her share of goodwill in cash. Prepare necessary accounts and balance sheet of new firm. Answer. Revaluation account. Debit particulars amount. Credit particulars amount. On debit side, to provision for workmen's compensation 10,000. To investment account 3,000. To machinery account 5,000. To bad debt account 3,000. To bad debt reserve account 9,000. Total of debit side 30,000. On credit side, by creditors account 5,000, by loss transferred to old partners capital account Kanha 10,000, Kavisha 15,000, total 25,000. Total of credit side 30,000. Partners capital account. Debit particulars Kanha, Kavisha, Palki. Credit particulars Kanha, Kavisha, Palki. On debit side, to bank account Goodwill Kanha 8,000, Kavisha 6,000. To revaluation account Kanha 10,000, Kavisha 15,000. To balance carried down Kanha 84,000, Kavisha 1 lakh, Palki 1,20,000. Total of debit side Kanha 1,02,000, Kavisha 1,21,000, Palki 1,20,000. On credit side, by balance brought down Kanha 80,000, Kavisha 1 lakh. By contingency reserve account Kanha 6,000, Kavisha 9,000. By bank account Palki 1,20,000. By premium for goodwill account Kanha 16,000, Kavisha 12,000. Total of credit side Kanha 1,02,000, Kavisha 1,21,000, Palki 1,20,000. Bank account. Debit particulars amount. Credit particulars amount. On debit side, to balance brought down 14,000. To Palki's capital account 1,20,000. To premium for goodwill account 28,000. Total of debit side 1,62,000. On credit side, by Kanha's capital account 8,000. By Kavisha's capital account 6,000. By balance carried down 1,48,000. Total of credit side 1,62,000. Balance sheet as on 1st April 2016 after admission. Liabilities amount, assets amount. On liability side, capital Kanha 84,000, Kavisha 1 lakh, Palki 1,20,000, total 3,04,000. Provision of workman's compensation claim 50,000. Creditors 45,000. Total of liabilities 3,99,000. On asset side, building 1,10,000. Machinery 45,000. Stock 30,000. Debtors 66,000. Less bad debt 6,000. Total 60,000. Less bad debt reserve 15% 9,000. Total 51,000. Investment 15,000. Bank 1,48,000. Total of assets 3,99,000. Explanation 1. Sacrificing ratio. Old ratio of Kanha and Kavisha is 2:3. Kanha sacrificed half of his share. Sacrifice of Kanha is equals to 2/5 into 1/2 is equals to 2/10. Kavisha sacrificed 1/4 of her share. Sacrifice of Kavisha is equals to 3/5 into 1/4 is equals to 3/20. Sacrificing ratio of Kanha and Kavisha is 2 by 10 is to 3 by 20 is equals to 4 by 20 is to 3 by 20 is equals to 4 is to 3, making denominator equal. Goodwill will be distributed to both partners in 4 is to 3 ratio. Number 2. Goodwill brought by Palki. Share of Palki in new firm is equals to sacrifice of Kanha plus sacrifice of Kavisha is equals to 2 by 10 plus 3 by 20 is equals to 4 plus 3 by 20 is equals to 7 by 20. Goodwill brought by Palki is equals to rupees 80,000 into 7 by 20 is equals to rupees 28,000. Goodwill brought by Palki will be distributed between Kanha and Kavisha in their sacrificing ratio. Journal. Number 1. Bank account debit 28,000 to premium for goodwill account 28,000. Number 2. Premium for goodwill account debit 28,000 to Kanha's capital account 16,000 to Kavisha's capital account 12,000. Number 3. 1. Claim for workman's compensation accepted is rupees 50,000 against the provision for workman's compensation rupees 40,000. Therefore, additional claim of rupees 10,000 are debited to the revaluation account. 2. Decreased value of investment is rupees 15,000 while investment fluctuation reserve is only rupees 12,000. Therefore, additional loss is debited to the revaluation account. Illustration 19. Riya and Gauri are the partners sharing profit and loss in the ratio of 1:2. They admitted Sanju as a new partner for 1/5 share on 1st April 2017. Sanju brings rupees 90,000 as capital in cash. After the adjustment of reserves, profit of revaluation and goodwill, the capital of Riya and Gauri was rupees 1,50,000 and rupees 2 lakh respectively. Partners decided to maintain new firm's total capital at rupees 4,50,000 in their new profit-loss ratio. Necessary amount is to be brought or withdrawn in cash. Prepare partner's capital account. Answer. Necessary calculation. Number 1. New profit-loss sharing ratio. Suppose total profit of the firm is 1. Sanju is admitted with 1/5 share. So, remaining share of profit is equals to 1 minus 1 by 5 is equals to 4 by 5, which is distributed between Riya and Gauri in the ratio of 1:2. So, new share of Riya is equals to 4 by 5 into 1 by 3 is equals to 4 by 15. New share of Gauri is equals to 4 by 5 into 2 by 3 is equals to 8 by 15. Share of Sanju is equals to 1 by 5, making denominator equal 1 by 5 into 3 by 3 is to 2. So new share of Riya is equals to 4 by 5 into 1 by 3 is equals to 4 by 15. New share of Gauri is equals to 4 by 5 into 2 by 3 is equals to 8 by 15. Share of Sanju is equals to 1 by 5, making denominator equal 1 by 5 into 3 by 3 is equals to 3 by 15. Hence, new profit-loss sharing ratio is equals to 4:8:3. Number 2. Capital of each partner in new firm. Total capital in new firm is rupees 4,50,000, which is distributed in the ratio of 4:8:3. New capital of Riya is equals to rupees 4,50,000 into 4 by 15 is equals to rupees 1,20,000. New capital of Gauri is equals to rupees 4,50,000 into 8 by 15 is equals to rupees 2,40,000. New capital of Sanju is equals to rupees 4,50,000 into 3 by 15 is equals to rupees 90,000. Partners' capital accounts. Debit. Particulars. Riya, Gauri, Sanju. Credit. Particulars. Riya, Gauri, Sanju. On debit side, to cash account, difference. Riya, rupees 30,000. To balance carried down. Riya, rupees 1,20,000. Gauri, rupees 2,40,000. Sanju, rupees 90,000. Total of debit side. Riya, rupees 1,50,000. Gauri, rupees 2,40,000. Sanju, rupees 90,000. On credit side, by balance brought down. Riya, rupees 1,50,000. Gauri, rupees 2 lakh. By cash account, Sanju, rupees 90,000. By cash account, difference, Gauri, rupees 40,000. Total of credit side, Riya, rupees 1,50,000. Gauri, rupees 2,40,000. Sanju, rupees 90,000. Illustration 20. Pandit and Pandya are partners in a firm sharing profit and loss in the ratio of 2:1. The balance sheet of the firm as on 31st March 2016 was as under. Balance sheet, liabilities amount, assets amount. On liability side, capital, Pandit 1,30,000, Pandya 1,20,000, total 2,50,000, capital reserve 21,000, workman's saving account 10,000, workman's profit sharing fund 12,000, 10% loan 50,000, creditors 57,000, total of liabilities 4 lakhs. On asset side, goodwill 30,000, building 2 lakhs, furniture 40,000, stock 26,000, debtors 24,000, cash 80,000, total of assets 4 lakhs. They admitted Patel as a new partner as on 1st April 2016 on the following terms. Number 1. New profit and loss sharing ratio is to be kept at 3:5:1. Number 2. Patel brought Rs 50,000 as his capital in cash. Number 3. Interest on loan is outstanding for last year. Number 4. Personal expenses Rs 8,000 of Pandya was debited to the profit and loss account. Number 5. Reconstruction's expense of Rs 12,000 is paid by Pandit. Number 6. Goodwill is valued at Rs 2,70,000. Number 7. Capital of Pandit and Pandya in the new firm should be kept in new profit and loss ratio by taking Patel's capital as the base. For this purpose, necessary adjustments are to be made in their current account. Prepare necessary accounts and balance sheet of the new firm. Revaluation account. Debit particulars amount, credit particulars amount. On debit side, to outstanding interest on loan 5,000, to Pandit's capital account 12,000, total of debit side 17,000. On credit side, by Pandya's capital account 8,000, by partner's capital account loss, Pandit 6,000, Pandya 3,000, total 9,000. Total of credit side 17,000. Partners capital accounts debit particulars Pandit, Pandya, Patel. Credit particulars Pandit, Pandya, Patel. On debit side, to goodwill account Pandit 20,000, Pandya 10,000. To revaluation account Pandya 8,000. To Pandit's capital account Pandya 60,000. To revaluation account Pandit 6,000, Pandya 3,000. To Pandit's current account Pandit 70,000. To balance carried down Pandit 1,50,000, Pandya 2,50,000, Patel 50,000. Total of debit side Pandit 2,46,000, Pandya 3,31,000, Patel 50,000. On credit side, by balance brought down Pandit 1,30,000, Pandya 1,20,000. By capital reserve Pandit 14,000, Pandya 7,000. By cash account Patel 50,000. By revaluation account Pandit 12,000. By Patel's current account Pandit 30,000. By Pandya's capital account Pandit 60,000. By Pandya's capital account Pandya 2,04,000. Total of credit side Pandit 2,46,000, Pandya 3,31,000, Patel 50,000. Cash account. On debit side, to balance brought down 80,000, to Patel's capital account 50,000, total of debit side 1,30,000. On credit side, by balance carried down 1,30,000, total of credit side 1,30,000. Balance sheet as on 1st April 2016 after admission. Liabilities amount, assets amount. On liability side, capital Pandit 1,50,000, Pandya 2,50,000, Patel 50,000. Total 4,50,000. Workers saving fund 10,000. Workers profit sharing fund 12,000. 10% loan 50,000. Creditors 57,000. Outstanding interest on loan 5,000. Pandit's current account 70,000. Total of liabilities 6,54,000. On asset side, building 2 lakh, furniture 40,000, stock 26,000, debtors 24,000, cash 1,30,000, Pandya's current account 2,04,000, Patel's current account 30,000. Total of assets 6,54,000. Explanation. Number 1. Sacrificing ratio. Old ratio of Pandit and Pandya is equals to 2:1. New ratio of Pandit, Pandya and Patel is equals to 3:5:1. Sacrifice is equals to old share minus new share. Sacrifice of Pandit is equals to 2/3 minus 3/9 is equals to 6 minus 3/9 is equals to 3/9. Sacrifice of Pandya is equals to 1/3 minus 5/9 is equals to 3 minus 5/9 is equals to minus 2/9, that is gain. Number 2. Entry for goodwill. Pandya gains, therefore he will also give goodwill to Pandit. Goodwill payable to Pandya is equals to 2/9 into 2,70,000 is equals to rupees 60,000. Goodwill payable to Patel is equals to 1/9 into 2,70,000 is equals to rupees 30,000. Goodwill receivable by Pandit is equals to 3/9 into 2,70,000 is equals to rupees 90,000. Patel does not bring goodwill in cash. Journal entry. Patel's current account debit 30,000, Pandya's current account debit 60,000 to Pandit's capital account 90,000. Note. As capital of all partners is to be kept in new profit sharing ratio, by taking Patel's capital as base, goodwill of Patel is debited to his current account. Number 3. Capital of partners in new profit loss sharing ratio. For 1/9 share of Patel, capital is equals to rupees 50,000. So total capital of firm is 1. Then how much is equals to rupees 50,000 into 9 is equals to rupees 4,50,000. Pandit's capital in new firm is equals to 3/9 into 4,50,000 is equals to rupees 1,50,000. Pandya's capital in new firm is equals to 5/9 into 4,50,000 is equals to rupees 2,50,000. Illustration 21. A and B are the partners sharing profit loss in the ratio of 2:1. The balance sheet of their firm as on 31st March 2016 was as under. Balance sheet, liabilities, amount, assets, amount. On liability side, capital A 80,000, B 40,000. Total 1,20,000. Reserve fund 21,000. Creditors 75,000. Bills payable 10,000. Total of liabilities 2,26,000. On asset side, plant machinery 80,000, building 50,000, stock 17,000, debtors 50,000, less bad debt reserve 4,000, total 46,000, cash bank 33,000, total of assets 2,26,000. They admitted C as a new partner on 1st April 2016 on following conditions. Number 1. A sacrificed 1/12th share and B sacrificed 1/6th share from their profit share in favor of C. Number 2. C will bring proportionate capital. 3. C will bring his share of goodwill in cash. Goodwill is valued at rupees 1,80,000. 4. Fixed assets are to be depreciated at 10%. Number 5. All debtors are solvent. Number 6. Insurance premium of rupees 3,000 is to be carried forward to the next year. Prepare necessary account and the balance sheet. Revaluation account. Debit, particulars amount, credit, particulars amount. On debit side, to plant machinery account 8,000, to building account 5,000, total of debit side 13,000. On credit side, by bad debt reserve account 4,000, by prepaid insurance premium account 3,000, by loss transferred to old partners capital account A 4,000, B 2,000, total 6,000. Total of credit side 13,000. Partners capital accounts. Debit, particulars A, B and C. Credit, particulars A, B and C. On debit side, to revaluation account A 4,000, B 2,000. To balance carried down A 1,05,000, B 75,000, C 60,000. Total of debit side A 1,09,000, B 77,000, C 60,000. On credit side, by balance brought down A 80,000, B 40,000. By reserve fund account A 14,000, B 7,000. By premium for goodwill account A 15,000, B 30,000. By cash account, C. 60,000. Total of credit side, A. 1,09,000, B. 77,000, C. 60,000. Cash account. Debit, particulars amount, credit, particulars amount. On debit side, to balance brought down 33,000, to C's capital account 60,000, to premium for goodwill account 45,000. Total of debit side 1,38,000. On credit side, by balance carried down 1,38,000. Total of credit side 1,38,000. Balance sheet as on 1st April 2016 after admission. Liabilities amount, assets amount. On liability side, capital A. 1,05,000, B. 75,000, C. 60,000. Total 2,40,000. Creditors 75,000. Bills payable 10,000. Total of liabilities 3,25,000. On asset side, plant 72,000, building 45,000, stock 17,000, debtors 50,000, cash 1,38,000, prepaid insurance premium 3,000. Total of asset side 3,25,000. Explanation. Number 1. Sacrificing ratio. Old ratio of A and B is equals to 2:1. A's sacrifice is equals to 1/12. B's sacrifice is equals to 1/6 is equals to 2/12. Sacrificing ratio is equals to 1:2. Number 2. Goodwill. C's share is equals to A's sacrifice plus B's sacrifice is equals to 1/12 plus 2/12 plus 3/12 is equals to 1/4. Goodwill brought by C is equals to 1/4 into 1,80,000 is equals to rupees 45,000. C's share of goodwill rupees 45,000 is to be distributed between A and B in their sacrificing ratio 1:2. Number 3. C's capital. A's capital in new firm rupees 1,05,000, B's capital in new firm rupees 75,000. Total capital of A and B is rupees 1,80,000. C's share in profit is equals to 1/4. Total share in profit of A and B is equals to 1 minus 1/4 is equals to 3/4. A and B's share 3/4 is equals to capital rupees 1,80,000, C's share 1/4, then how much? Is equals to 1,80,000 into 1/4 into 4/3 is equals to rupees 60,000. Illustration 22. Prerna and Piyush are partners in a firm sharing profit and loss in the ratio of their capital. Balance sheet of their firm was as under. Balance sheet as on 31st March 2016. Liabilities amount, assets amount. On liability side, capital accounts, Prerna 50,000, Piyush 1,50,000, total 2 lakhs. Reserve fund 30,000, creditors 40,000, outstanding expenses 1,500. Total of liabilities 2,71,500. On asset side, building 90,000, furniture 17,500, machinery 1,07,500, stock 17,500, debtors 30,000, cash bank 8,250, accrued income 750. Total of assets 2,71,500. They admitted Poyani as a new partner, fourth share of profit on 31st March 2016 on following terms. Number 1. Poyani brought rupees 62,500 as capital and rupees 24,000 as her share of goodwill in cash. 60% amount of goodwill is withdrawn by the old partners. Number 2. Market value of stock and machinery is rupees 20,000 and rupees 1,20,000 respectively. Number 3. Provision for bad debt at 10% and 2% discount reserve on debtors is to be made. Number 4. Creditors are to be paid rupees 30,000. Number 5. Value of building is to be increased by 15% and value of furniture is to be increased by 20%. Number 6. Outstanding wages of rupees 460 is not recorded in the books. From the above information, prepare necessary accounts and new balance sheet of the firm. Answer. Necessary calculation. Number 1. Prerna and Piyush are sharing profit and loss in the ratio of their capital. Capital ratio is equals to rupees 50,000 is to rupees 1,50,000 is equals to 1:3 old ratio. Number 2. Poyani brought 24,000 as her share of goodwill in cash. Number 1. Cash account debit 24,000 to premium for goodwill account 24,000. Number 2. Premium for goodwill account debit 24,000 to Prerna's capital account 6,000 to Piyush's capital account 18,000. Number 3. 60% amount of goodwill is withdrawn by the old partners. Prerna's capital account debit 3,600, Piyush's capital account debit 10,800 to cash account 14,400. Revaluation account debit particulars amount, credit particulars amount. On debit side, to bad debts reserve 3,000, to discount reserve on debtors account 540, to outstanding wages account 460, to capital accounts profit 1:3, Prerna 9,500, Piyush 28,500, total 38,000. Total of debit side 42,000. On credit side, by machinery account 12,500, by stock account 2,500, by creditors account 10,000, by building account 13,500, by furniture account 3,500. Total of credit side 42,000. Partners capital accounts debit particulars Prerna Piyush, credit particulars Prerna Piyush. On debit side, to cash account Prerna 3,600, Piyush 10,800. To balance carried down Prerna 69,400, Piyush 2,08,200. Total of debit side Prerna 73,000, Piyush 2,19,000. On credit side, by balance brought down Prerna 50,000, Piyush 1,50,000. By reserve fund account Prerna 7,500, Piyush 22,500. By premium for goodwill account Prerna 6,000, Piyush 18,000. By revaluation account Prerna 9,500, Piyush 28,500. Total of credit side Prerna 73,000, Piyush 2,19,000. Cash bank account debit particulars amount, credit particulars amount. On debit side, to balance brought down 8,250, to Poyani's capital account 62,500, to premium for goodwill account 24,000. Total of debit side 94,750. On credit side, by Prerna's capital account goodwill 3,600, by Piyush's capital account goodwill 10,800, by balance carried down 80,350. Total of credit side 94,750. Balance sheet as on 31st March 2016 after admission of Poyani. Capital liabilities amount, assets receivables amount. On capital liability side, capital accounts Prerna 69,400, Piyush 2,08,200, Poyani 62,500. Total 3,40,100. Creditors 30,000. Outstanding expenses 1,500. Outstanding wages 460. Total of capital liabilities 3,72,060. On assets receivable side, building 1,03,500. Furniture 21,000. Machinery 1,20,000. Stock 20,000. Debtors 30,000. Less bad debts reserve 3,000. Total 27,000. Less discount reserve 540. Total 26,460. Cash balance 80,350. Accrued income 750. Total of assets receivables 3,72,000. Illustration 23. Shivani and Neeraj are the partners in a firm sharing profit and loss in the ratio of 1:2. Balance sheet of their firm as on 31st March 2016 was as under. Balance sheet, liabilities amount, assets amount. On liability side, capital account Shivani 1 lakh, Neeraj 1,50,000, total 2,50,000. Profit loss account 9,000. General reserve 15,000. Creditors 25,000. Bad debt reserve 8,000. Total of liabilities 3,07,000. On asset side, goodwill 27,000. Land building 1,50,000. Machinery 50,000. Stock 20,000. Debtors 30,000. Bills receivable 10,000. Cash 20,000. Total of assets 3,07,000. They admitted Vijay as a new partner as on above date for the following terms. Number 1. Bad debt reserve is to be kept Rs 5,000 on debtors. Number 2. Goodwill is valued at Rs 36,000. Number 3. Value of land and building is to be appreciated by 10%. Number 4. Book value of machinery is 25% more than its market value. Number 5. Value of stock is to be decreased by 10%. Number 6. Vijay will bring 50% of net assets of new firm as the capital and his share of goodwill in cash. Number 7. Shivani sacrifices 1/3 of her share and Neeraj sacrifices 1/3 share for Vijay. Prepare necessary accounts and balance sheet after admission of a new partner. Answer. Revaluation account. Debit particulars amount. Credit particulars amount. On debit side, to machinery account 10,000, to stock account 2,000, to profit transfer to old partners capital account Shivani 2,000, Neeraj 4,000. Total 6,000. Total of debit side 18,000. On credit side, by bad debt reserve account 3,000, by land building account 15,000. Total of credit side 18,000. Partners capital accounts debit particulars Shivani, Neeraj, Vijay. Credit particulars Shivani, Neeraj, Vijay. On debit side, to goodwill account Shivani 9,000, Neeraj 18,000. To balance carried down Shivani 1,05,000, Neeraj 1,64,000, Vijay 2,69,000. Total of debit side Shivani 1,14,000, Neeraj 1,82,000, Vijay 2,69,000. On credit side, by balance brought down Shivani 1 lakh, Neeraj 1,50,000. By profit loss account Shivani 3,000, Neeraj 6,000. By general reserve account Shivani 5,000, Neeraj 10,000. By premium for goodwill account Shivani 4,000, Neeraj 12,000. By revaluation account Shivani 2,000, Neeraj 4,000. By cash account Vijay 2,69,000. Total of credit side Shivani 1,14,000, Neeraj 1,82,000, Vijay 2,69,000. Cash account debit particulars amount, credit particulars amount. On debit side, to balance brought down 20,000, to premium for goodwill account 16,000, to Vijay's capital account 2,69,000. Total of debit side 3,05,000. On credit side, by balance carried down 3,05,000. Total of credit side 3,05,000. Balance sheet as on 1st April 2016 after admission. Liabilities amount, assets amount. On liability side, capital account Shivani 1,05,000, Neeraj 1,64,000, Vijay 2,69,000. Total 5,38,000. Creditors 25,000. Bad debt reserve 5,000. Total of assets 5,68,000. On asset side, building 1,65,000, machinery 40,000, stock 18,000, bills receivable 10,000, debtors 30,000, cash 3,05,000. Total of assets 5,68,000. Explanation. Number 1. Sacrificing ratio. Old profit loss sharing ratio of Shivani and Neeraj is equals to 1:2. Shivani sacrificed 1/3 of her profit share. Sacrifice of Shivani is equals to 1/3 into 1/3 is equals to 1/9. Neeraj sacrificed 1/3 from his profit share. Sacrifice of Neeraj is equals to 1/3. Sacrificing ratio is equals to 1/9 is to 1/3 is equals to 1:3. Number 2. Distribution of goodwill. Share of Vijay is equals to sacrifice of Shivani plus sacrifice of Neeraj is equals to 1/9 plus 1/3 is equals to 1 plus 3/9 is equals to 4/9. Share of goodwill of Vijay is equals to 36,000 into 4/9 is equals to Rs 16,000. Goodwill of Vijay will be distributed between Shivani and Neeraj in their sacrificing ratio 1:3. Number 3. Book value of machinery is Rs 50,000, which is 25% more from its market value. Therefore, If market value of machinery is rupees 100, its book value is rupees 125. Determine the market value of machine as under. Book value 125. Market value 100. If book value 50,000, then market value is how much? Is equals to 100 into 50,000 divided by 125 is equals to rupees 40,000. Number 4. Capital is brought by Vijay. Vijay brought 50% of net assets of firm as capital. Net assets is equals to total assets minus total liabilities. Total assets minus total liability is total capital. 50% of total capital is brought by Vijay as his share of capital in new firm. Capital of Shivani in new firm rupees 1,05,000. Capital of Neeraj in new firm rupees 1,64,000. Total capital of Shivani and Neeraj in new firm is equals to rupees 2,69,000. 50% of total capital is brought by Vijay. Remaining 50% capital is of Shivani and Neeraj. 50% capital is equals to rupees 2,69,000 of Shivani and Neeraj. 50% of capital of Vijay is equals to how much? Is equals to rupees 2,69,000. Illustration 24. A and B are partners in a firm sharing profit and loss in the ratio of 2:1. They admitted C as a new partner for 1/5 share in the profit. C will acquire 1/10 share from A and 1/10 share from B. Answer. Old ratio A and B is equals to 2:1 is equals to 2/3:1/3. Share of C is equals to 1/5 share. C will acquire 1/10 share from A and 1/10 share from B. Therefore, sacrifice of A is equals to 1/10 from his profit, sacrifice of B 1/10 from his profit. New share of old partner is equals to old share minus sacrifice. Therefore, new share of A is equals to 2/3 minus 1/10 is equals to 20 minus 3/30 is equals to 17/30. Therefore, new share of A is equals to 1/3 minus 1/10 is equals to 10 minus 3/30 is equals to 7/30. Therefore, new share of C is equals to 1/5. Making denominator equal, 1/5 into 6/6 is equals to 6/30. Therefore, new profit loss sharing ratio of A, B and C is equals to 17:7:6. Sacrificing ratio. Name of partner A, old share 2/3, new share 17/30. Sacrifice is equals to old share minus new share is equals to 2/3 minus 17/30 is equals to 60/51/90 is equals to 9/90 is equals to 1/10. Result, sacrifice. Name of partner B, old share 1/3, new share 7/30. Sacrifice is equals to old share minus new share is equals to 1/3 minus 7/30 is equals to 30/21/30 is equals to 9/90 is equals to 1/10. Result, sacrifice. Therefore, sacrificing ratio of A and B is equals to 1/10 is to 1/10 is equals to 1:1.